In this video, you'll be learning about this topic.
So as a person who likes to just look at patterns, right? I suspect that the more that you step in and start manipulating the market and there's a pattern that kind of shows up, everyone that's watching this is saying, oh, well, this is what worked last time when they stepped in and did this. So now I'm just going to hit the copy paste button here and do this all over again. And if there's one thing we learned from COVID, it's that tech was a major winner coming out of the debasement of the currency. So let's just play out the scenario where they wait too long and they don't provide enough stimulus and they have to step in because there's just a major liquidity crunch like we saw previously with the COVID. I mean, I would think that a person is looking for some type of technical limitation or they're looking at how much the government arrives to the table. I suspect they're going to arrive in a form that triumphs anything that we have seen historically as far as debasement goes. I mean, if they did 5 last time, I guess I'd naturally think they're going to do double that. Enormous numbers, like numbers you can't even fathom. So do you step into that trade again, into the tech, Google, Amazon, Apple, companies that you know are just going to continue to perform? Do you buy that equity?
I buy that equity. I buy in U.S. industrials equities. I buy gold. I buy Bitcoin. I buy all those things. I do step into it again. Because again, the thing that gives me the comfort to do that is the big gears of what we're talking about, which is debt to GDP is now 135%. You cannot allow GDP to fall for very long because you get into a debt death spiral. You have the 3 big gears of your government: entitlements, defense, and interest expense, 140% of tax receipts. Tax receipts are falling sharply as a result of all this. If they don't do enough fast enough, your entitlement bill doesn't go down, it goes up. Your defense bill isn't changing. If anything, it's going up. And your interest expense isn't really going anywhere per se. But as we saw in COVID, if Treasury does some special stuff, they're going to do some. And so when you look at that, you're 40% short relative to tax receipts on those expenditures, which are non-negotiable. You can't skip any of those things.
And I think that's a key point that the listeners should really pay attention to, because you're talking about these 3 items that are just so important to understand. They're non-discretionary expenses, so entitlements, defense, and interest expenses. And they have to be paid no matter what. And right now, we're at 104% of tax receipts, and tax receipts are falling.
Let's pretend they don't do enough. How quickly will the Fed step in? Well, you can say, okay, 140% of tax receipts. If you did nothing, that you've got well less than a year before you default on one of them, right? You literally don't have the money if you're just paying hand to mouth. So then you say, okay, well, I'll just borrow the money. And you say, okay, well, who's buying the treasuries? The U.S. net international investment position is negative 60% of GDP. So foreigners own in gross 40 trillion in assets, net 12 trillion in assets, dollar assets. If you don't do enough, the dollar's going to be going up. The dollar debts they owe are going to be squeezing them. They are going to be liquidating dollar assets for dollars, and they're going to be selling what they can, not what they want to. And what they sell that they can is the quote unquote deepest, most liquid market in the world, treasuries. So the government now needs to sell treasuries to finance this 140% of tax receipts, 3 big 3 items. So they're selling treasuries. Foreigners who have own $11-12 trillion in U.S. assets are going to be selling treasuries for dollars. Mom and pop are going to be selling treasuries for retirement. Businesses who are holding treasuries going to be selling treasuries. Banks who own treasuries for high quality liquid asset purposes for regulatory reasons so that they have proper liquidity in a crisis are going to be selling treasuries. So there's trillions of treasuries for sale. Where's the bid? Who's the bidder? The Fed's the bidder. That's it. And so that's why I say I step into that trade is it's going to be uncomfortable as heck possibly. If they don't do enough, you could absolutely see this sharp sell-off, this sharp dollar spike, and it is going to feel terrible, just like it felt in March. But my bet is the U.S. government will not be the first government to allow itself to be shut down for lack of printed fiat currency in history that I'm aware of.
Yeah, I think that the scar tissue from the early 1930s is so deeply entrenched into policymakers' minds as we're never going to go down that path again. And when you look at how that played out initially from 1929 up until they basically relinquished themselves off of this gold standard in 33, I mean, it was a deflationary spiral because policymakers were, well, if you're not competent enough to run your business appropriately and have savings for rainy days, well, then you deserve to fail, right? And you literally have the exact opposite line of thinking from policymakers today than what you had during that period of time. And so I see folks on Twitter from time to time that are posting these charts that are analogous to the 1929 Great Depression and it coming down and all that kind of stuff. And I'm looking at that and I'm saying, yeah, you might see like liquidity shocks that are somewhat mind-blowing how quickly they drop 30% or whatever. But the policy response to that is going to be so drastically different that I just don't see it playing out as a one-to-one kind of scenario like what happened back then.
I agree. It's different. So 29 to 33, the market was falling in dollar terms, but it was really falling against gold because it was a gold-backed dollar. And if you look at, for example, the equity market since 3Q18, it is down versus gold. It has fallen versus gold. You look at the equity market since 2000, it is down tremendously in gold terms. I think that's one important thing. I think the other thing that is really kind of stuck in my craw, a chart that I saw, and it's a brilliant chart by Dan Oliver at Mermican Capital. He gave a presentation on Real Vision back in March. If you haven't seen it, it's excellent. And I've had dinner with him before. He's brilliant. He's a gentleman. One of his investment letters back in May had this tremendous chart, and it showed the price of gold in German Reichsmarks from 1914 to 1923. So the beginning of World War I, when the Germans went off gold and said, we're just going to print the money to pay for the war and we're going to make the losers pay for it, which is what everybody said in World War I. And through 1923. So 14 to 23 is one of the, particularly 18 to 23, 20 to 23, one of the great currency hyperinflations of all time, complete currency destroying hyperinflation. And Dan's chart shows the price of gold in Weimar German marks go from 14 to 23, and it does what you think it does. On a annualized basis, it's a hockey stick up, currency gone. But the fascinating thing that I didn't know until I saw this chart was, I think he has it month over month. And what it showed, the month over month returns on gold, as the yearly return was, as the currency was hyperinflating at zero, the month over month returns on gold, if you were levered, if you were, because you would think, okay, well, the currency is going to hyperinflate. I want to borrow as much as I can and buy as much gold as I can, and I'm going to be rich. And the reality is if you look at how gold traded in a hyperinflating currency, if you were levered, you lost all your money 4 or 5 different times because there were periods where you, like you just said, these air pockets you hit, and there's any number of reasons that happens. A lot of them in these situations are very political. A certain leader gets elected, a certain leader in Germany's case gets assassinated. Whatever the case was, I mean, there were times when the German mark, Reichsmark, rose significantly against dollars for a few months and gold got killed. And then sort of the longer. So the point is I think very supportive of what you just said, which was that you get these counter trend moves, but I just don't think when you're in this purely fiat system that you're going to get these, when I see the analogs of, hey, this is 1929 and we're going to have this 4 years down of equity markets. I just don't think that's going to happen because it's an apples to orange comparison. It was comparing against gold then versus dollars now. And the equity market effectively is the economy now. And we're highly indebted. So it is the economy. There's this circular doom loop they've created by policy over the last several decades where they've got to have stocks rising to be able to keep the wheels on the cart as it relates to the fiscal situation.
I just want to tell the audience. So while you were talking there and your comment about gold, if you price the S&P 500 in gold, it's down significantly since 2000. So I went and I plotted this out. I priced the S&P 500 in gold. It is down 65% in terms of gold since the year 2000. I had no idea it was that much throughout that period of time. If you go to, let's see here, the 2008 time frame, the top, wow, that is just crazy. I had no idea it was that much, Luke.
Yeah.
And from 2008 till now, it's pretty much flat. The S&P 500 has not even gone up at all.
In nominal terms, you're saying, in dollar terms.
In gold terms, yeah.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.